OK， 再给大家就是大概2-3分钟的时间。
Hopefully during the right time.
OK， 好，那我们就准备开始了。大家好，我是王雅茹，我是Founder of Movement Matter Physical Therapy。那今天一样很感谢大家，就是上来这个 workshop。 我知道这个时间对很多爸爸妈妈来讲不是最好的时间，但是因为6点这个时间是我跟 Neil 可以同时在这边，然后我们的儿子正在吃饭，所以等一下吃完饭我就会去弄他睡觉，我就把交给 Neil 来跟大家分享。OK， 今天的主题就是要在讲说，怎样 save for kids education。那我的先生 Neil 呢，他已经在financial industry for more than 10 years。那基本上 he specialized in helping family and also small business。所以我们家的 finance 基本上都是他在负责。那等一下我就请他跟大家分享，就是说，他是。就是在存教育基金这方面有哪些地方可以存，跟我们是怎么样帮我儿子就是 design 一个 plan 的。OK， 那我就要把这个荧幕交给他了。OK.
Vincent agrees too. Hello, everybody. So my Mandarin isn't very good. I can get by, but for the purposes of the seminar, I'm going to be using English. So I appreciate all of you for being here, taking time out of your schedules, right? Like my wife said, it's probably not the best time, but we're feeding our son right now. So I just want to introduce myself real quick. So I've been in this industry since I was 20 years old. I'm 33 now. So I've been in the industry for 13 years. And one of the main reasons why I wanted to get involved in this industry is because I realized, growing up here, that they don't really teach us much about finance and savings and investments and all these different things, right? And so after school, I started working. I didn't really know what to do with my money. And I realized how important it is, right, to know about what to do with your money, how to save and where to invest and how to get a better interest rate and how not to pay so much taxes and all these different things, right? And so, that's one of the reasons why, I've been doing this for so long and I love what I do. Because not only have I been able to educate myself on what to do with our money and how to save for our son's education and the best ways to save for his education. And I'm going to show you some examples of what we did for him, right? So he's, obviously all of you've probably seen him before on, Instagram, social media, right? He's a 9-month, my 9-month old son. So let's get started. So I'm going to go over, the seminar today will last about 30, 40 minutes, and I will leave some, maybe a few minutes, 5 minutes afterwards for some Q&A. Okay. So, all right. And again, if you guys come on in, please mute yourself. So let's talk about it, right? So how much is college expense, right? This resource is from the College Board, right? Trends in college pricing in 2017, right? As you can see, from 2016 to 2017, there's been a steady rise. There's been an increase of about 3% or more, right? You can see this is a public 2-year, right? Versus a public 4-year in-state, public 4-year out of state, and private nonprofit 4-year, right? Ranging from 12,000 to 47,000. That's about average, right? Obviously, there's a lot of schools in California and other states and cities that are a lot more expensive, right? So the next thing I want to share with you is the cost currently to attend some of these different universities, right? USC, right? Very popular school. A lot of people, want to send their kids to USC, right? It's in LA, obviously. The total cost is about $71,000. And I'll show you an example later of actually my partner's sister actually went to USC and how we were able to help their family qualify for a lot of financial aid. So that, whatever they spent out of pocket was very little, right? So tuition is about $55,000 with room and board about $15,000, right? If you look at UCLA, right, it's a public 4-year university. Total cost around $35,000, $19,000 tuition, about $15,000 room and board, right? Columbia University, right, in New York City, is $71,000, right? Tuition's $57,000, room and board is about $13,000, $14,000, right? Cal State Fullerton, about $32,000 as well, right? So now this is to show you how much college education expenses have increased, okay? And it continues to increase, right? So between 2011 to 2012 and 2016 to 2017, published tuition and fee prices rose by 9% in public 4-year sector, right? As you can, as you can see right here. on the bottom, right? And then by 11% at public 2-year colleges and by 13% at private, non-private 4-year institutions adjusting for inflation, right? You can see right here the 5-year change since 1976 to 2017, right? 35%, 19%, 15%, right? That's the increase in 5 years, right? Back in 1976, if you look at a private nonprofit 4-year, right, it's about 16,000, 17,000. A public 4-year is about 8,000. If you look at 2017, that's triple to 45,000, right? And then public about 2.5 times, almost triple as well. Okay. So definitely college is getting more and more expensive, right? And this shows you, this is a graph of the chart that I just showed you, right? As you can see right here, private 4-year back in 1971, 1,800, and now it's 32, right? Public was 400, now it's 9,000. 2-year is 200, now it's 3,500, right? And you could see, you know, the line, the red line represents private 4-year, orange line represents public 4-year, and the gray line represents a public 2-year, right? So you look at it's about a 6-7% average cost per year, average increase, right, per year that is increasing by. Okay, so if this continues at this trend, it's going to be way too expensive, right? So let's talk about it, right? So the challenges of planning for your education. So who pays for it, right? Is it the parents pay? Is it the students pay? Is it free money from financial aid, right? You know, like the parents right here, you can see that person's a little stressed out because he has to, you know, think about spending, you know, $25,000 to $70,000 a year for college, right? Or is it the student, right? A lot of parents, they just go, okay, well, you know, you're on your own, school's on your own. So they get into, you know, a lot of student loans, a lot of debt that they have to end up spending the next 10, 20 years paying off, right? A lot of my friends I know still are paying off their student loans, right? Or is it student aid? Okay, is it financial aid? Is it free money, right? Who decides this? Well, the good part about this is you decide. Okay, you can actually decide how much you pay, how much your kids pay, and how much financial aid you get. Okay, so I'm going to go over that with you today. So long-term strategy for asset accumulation, right? Let's talk about it. So does your college education savings or whatever you're putting your money in for your kids' future, for their future education, does it have growth potential? Can it grow to accomplish, right, the goals? Okay, the cost. Is it risky? Does it have a lot of risk? If the stock market goes down, right, are you going to lose a lot of money, right? Like last year, right, first quarter, market took a huge drop, 30, 40%. Obviously, it rebounded very nicely. But the question is, what if your son's what if your kid, your son or daughter is about to go to school and the market drops, right? Is it tax advantaged, or do you have to pay a lot of taxes, right? Do you have access to the money, right? Is it only for their education? Or what if your kids don't go to college, right? Because we cannot control whether or not our kids go to college or not. Maybe some of you disagree with me, right? Right. But, you know, for us, you know, we're not going to force our son or, you know, future kids to go to school. If they want to go to school, great. If not, well, the money's saved there for them for other purposes, right? That he may have access to, right? So it's not just for college, right? Because, and I'm going to go over a lot of different plans. If you don't use it for their college, you want to take it out, you're going to have to pay penalties and taxes, right? And financial aid impact, wherever you put your money, does it impact your financial aid? Does it impact your ability to be able to receive more money, free money from financial aid? Okay. I'll give you an example, right? You also will always want to start early. This is just an example. Let's say you start saving $10,000 a year for your child's education or children's education, right? This is just showing you on an average 8%, right? By the time they are 18 years old, right, you would have totally invested about 180,000, and that would have grew to 374,000, right? Double, pretty good, right? That's probably enough, right? What if, you know, you go, whatever the reason is, you wait, right? Whether it's money, whether it's, you know, you don't think you don't need to start right now. Whatever the reason is, you don't start right now. You wait, like most parents do, right? Unfortunately, and they wait until they're 10 years old and then they start saving, right? Because obviously you got to start saving a lot more. You actually need to save $30,000 a year by the time they're 10 years old to 18 years old to equal 375,000. The difference is you would have invested 90,000 more to get the same amount. Why? Because of time. Time could be your best friend or it could be your worst enemy. Okay, so I want to share with you a quick concept. It's called Rule 72, right? This is compound interest, how money works. Pretty much you take 72, you divide it by the interest rate that you're getting on your money. It equals the number of years that your money will double. So let's say, for example, at 4%, let's say your money is growing at 4%. So 72 divided by 4 equals 18 years, as you can see right here, right? And so let's say you're 29 years old and you would have put in $10,000 into a place that gives you 4% rate of return in interest every year. That, and you don't add any more money. You just put in one time 10,000, let it sit there and grow. That means in 18 years, when you're 47, your 10,000 will double to 20,000. And in another 18 years, when you're 65, your 20,000 will double to 40,000. If I were to ask you guys, right, is this good? Do you think this is good? Right? Some of you will say yes. Some of you will say no. In my opinion, it's not good enough. It's better than the banks, but it's definitely not good enough. Right? We need a lot more return, right? Let's look at 8%, right? 8% is a pretty good average, a consideration if you look at the stock market and different types of investments, right? So your money doubles every 9 years. So you look at the same time frame when you're 65, you don't have 40,000, you have 160,000. You see, 4% more in the long run in 36 years, it means you're going to quadruple 4 times your money. You see, this is the things they don't teach us in school. Like, I didn't know about this until I started with this company, and they taught me about it. 4 times the money, right? That's definitely something we can do, right? And if you look at 12%, right, that's, very aggressive, right? 4% more means you're going to 4 times your money again at 65. So you have 640,000 instead of 160 or 40, right? The question is, do you want 40, 160, or 640? Right? Of course, that's a silly question. Of course, everybody say, I want 640. But the question is, well, how do you get that? Right? And how do you get that without taking so much risk as well? Well, that's what I'm going to share with you as well. Okay. Let's talk about taxes, right? That's one of our favorite subjects, right? There's tax now. There's places you can save for your kids' education. You can put in your checkings account. You can put it in a savings, a CD, a stocks, or mutual fund, right? But the rental income, real estate as well. But the problem with this is, in terms of taxes, I'll talk more about the challenges later, is that you have to pay taxes, right, before you get your money, right? Because you're using after-tax money to invest in here. And every year from stocks and mutual funds, you earn dividends and interest. You got to pay taxes on that. And then when there's a gain and you want to take out your money, you got to pay capital gain taxes, right? Short-term capital gain or long-term capital gains, right? So 15, 20%. Okay. Now, tax later is like your 401k, IRA, annuity, different pensions and all that, right? This, you're taxed later, right? But the problem is that we don't know what tax rates are going to be later. Right? If I were to ask you, what do you think tax rates will be like in 20, 30 years, or in 18 years, or in 15 years when your child goes to school, right? Goes to college or further education, further advancement, right? What are the tax rates going to be, right? Well, most people say it's probably going to be higher, and it's already been going higher, right? Especially with the new administration, right? And what about tax-free vehicles? Well, there's a Roth IRA and a 7702 plan, right? And 529 plan. So we're going to go over all the different types of college education or education planning accounts, right? Different vehicles, and share with you the good and the bad about each. Okay. So these are all the different types of education. You could do it in your savings, your CD, taxable investments like mutual funds, right? Uniform gifts, transfer to minor act, right? Custodial accounts, UGMA, UTMA, right? Cloverdale education savings accounts, qualified tuition plans, 529 college savings plans. Those are the most popular that people at least heard of in terms of familiarity of what people heard of, right? 529 prepaid tuition plans, and also cash value and permanent life insurance, right? Which is what I got for my son. And I'll explain to you why. Right, the reason why we did that. Now, the cool part is, we could do all these except, I don't work at a bank, so I can't help you open a savings account or a CD. But most of these other ones we can also help you with, right? It just depends on what's the best fit for you, right? That's pretty much the bottom line at the end of the day, right? So let's talk about 529 plans, savings plans. All states offer these plans, okay? Contributions to 529 accounts will grow tax deferred, similar to 401k, IRA, and that as the years go by, you're not paying taxes every year like you are in stocks and mutual funds, right? That's what tax deferred means. As the account owner, all right, you, the parent, you stay in control of the account at all times, right? So your kids cannot use it to spend money on whatever they need, right? No income limits to open an account. That's a good thing, right? Nor age limits to be beneficiary, nor age limit to open an account, right? High limit is $13,000 per donor, $26,000 per couple. About $130,000 can be contributed per beneficiary in 1 year if married filing jointly.
Yeah.
State income tax benefits for some states plan. Please mute yourself, please. Okay, thank you. What are the pros and the cons? The pros are it's tax deferred, right? So you don't have to pay taxes every year. You do a mutual funds and stocks, right? Tax-free withdrawals when it's used for education. Okay, so it grows tax deferred. You don't pay tax every year, and then when you take it out, it's tax-free. Okay, but only if you use it for education purposes. Okay, and it's invested in mutual funds offered through each program provider. So it could be with Fidelity, it could be with Janus, it could be with American funds, right? Depending on Vanguard, right? Some of these companies you heard, right? You do not need to choose your home state program. Like, what are the cons, right? Well, if you don't use it for your kids' education, then guess what? You're gonna have to pay taxes plus a 10% federal penalty, similar to a 401k and IRA. Where if you take the money out before 59 and a half, right, unless it's a hardship or higher education, right? So you have to pay penalties and taxes if you do not use the money for your kids' education. So there's not a whole lot of flexibility there. And like I said, we cannot control whether our kids go to school, right? We can encourage them to, right? But we can't really force them to, right? Lack of investment management flexibility. So may change investments only once a year, right? I've seen a lot of these 529 plans. And typically there's, like I said, lack of flexibility in terms of your investment options, right? So needs money while the 529 plan investment is at a loss. It's like what I said earlier. What if your son or daughter is ready to go to school and the market crashes, right? You lose 30%. Well, that's not good, right? So it can also be grandparent owned, right? So that they control it and has an impact on financial aid. So the more of this you have, the lesser you'll qualify for financial aid. That means the less money you'll get from financial aid, okay? What about UGMA and UTMA, right? The pros, up to $13,000, $26,000, like I mentioned, a year, no restriction on the money usage, tax savings on earnings, right? Some of these details we can go over. If you guys are interested afterwards for a free, 30-minute consultation, I'll be, sending you information about that, right? So we could set up a free consultation for 30 minutes and I could go into the details of the specifics, answer any specific questions as well. Later on, I can answer some general questions, but, I don't want to spend too much time to get into the specifics because I know, you guys have family and maybe some of you haven't eaten dinner yet. You need to put your kids to bed, right? So what are the cons, right? There's no special tax benefit for education, okay? Under children's name, 20% will be assessed in financial aid. So again, the more of this you have, and if it's under your kids' name, 20% of it will be assessed in financial aid, which means that, you'll qualify for less free money, right? Children assumes control at age of majority, 18 or 21 in most states, which I don't think most parents want their 18-year-old to assume full control of the money, right? They probably might not use it for their tuition, right? What about Cloverdale Education Savings Accounts called the Education IRA, right? Tax deferred growth, tax-free, same thing, right? You don't pay tax every year. The distributions you take out is tax-free. Flexible investment options, right? Can be used for qualified elementary, secondary, and higher education. What are the cons? You can only put in $2,000 a year, right? No contribution allowed when the beneficiary reaches 18 years old. That means your child reaches 18 years old, right? So $2,000 a year, 18 years, that's $36,000. What is that? They're going to cover a year or maybe two, right? It's very, very limited, right? Tax plus penalty on earning non-qualified usage, same as a 529 plan. If you don't use it for your kids' education, penalties and taxes, okay? Pay income tax when receiving scholarships or fellowship. Under kids' name, 20% will be assessed in financial aid, right? Tricking when claim hope or lifetime learning credit, okay? Cannot be refunded to the parents, okay? So if they don't decide to go to the school, you cannot get the money back, okay? So must be withdrawn by beneficiary before reaching age 30. Well, what if your kids decide to go back to school later on? Okay, they wouldn't be able to use it, right? So what about 529 prepaid tuition pretty much you buy tomorrow's education at today's price. Covers tuition, fee, room, board, other expenses, most of the costs. 19 states offer this plan, right? So if you're in California, unfortunately they don't. If you're in these other states, they do. It's treated as an asset of the account owner, right? So you, the parents or the grandparent. What are the disadvantages? There's lack of flexibility, right? When students choose to attend out-of-state college and direct the refund to the institution, refund payments will be based on average tuition of all Florida public four-year university or whatever state you're in. So here's the thing, for example, whatever tuition school you chose, right, it may charge you more, but then the refund will be based on the average, so you may get less back, right? Student receiving scholarships, canceling the contract, or choosing not to attend college will receive purchase payments without interest. So they'll give you back your money in payments, but you don't get any interest. So it's pretty much you gave them all your money and they didn't give you any interest in it, right? Kind of like putting your money in a savings account, right? I mean, but you get 0.001, better than nothing, right? But the dormitory plan covers the cost of standard double occupancy dormitory designated by university, right? And definitely has an impact on financial aid. So again, if you have these plans, it will impact your ability to receive more free money from financial aid, okay? So what are the categories aid? There's a merit base, which is based on what? Based on the student's performance achievement. Most people, there's a lot of misconceptions and misunderstandings about financial aid. For example, a lot of people think, oh, I make too much money, I don't qualify. I'm going to show you some examples later down the road. Okay, I mean, not later, in a little bit. And there's need-based, based on FAFSA and CSS profile data, right? So which one gives you more? Well, need-based gives you more. So I'll show you some examples with you, right? So FAFSA.gov, right? This is how you apply for FAFSA. Okay, so you want to make sure you do that every year, right? It needs to be completed every year. Some financial aid is awarded first come, first served basis, so you want to make sure you do this right away, right? And so need-based financial education, grants, scholarships, right? Loans, obviously you need to pay back the loans, right? Work, study, need time and pay taxes, okay? So what FAFSA does is they have a formula to calculate what you get, right? So how much aid can you get? It's the cost of attendance. So whether it's 30,000, 50,000, or 70,000, right? What's the cost of attendance minus your family's contribution? So they will calculate, right, what they believe based on your income, your kids' income, your assets, and your kids' assets, based on all that information that you filled out on the financial aid application, on the FAFSA application, they will determine what they believe you can contribute, okay? So families contribution, expected family contribution. COA stands for cost of attendance, equals financial need. Give you some examples, right? This is the formula. I'm not going to go into too much detail about this, right? Might be a little bit confusing. We could talk about on one-on-one basis, right? So parents' income, right? Deduction will be counted back in expected family contribution. So for example, if you reduce your taxable income, right, then that helps, right? Because the more income you have, the less you get. And I'll show you a chart later on, right? So 401ks, IRAs, you can also start a business if you don't have one. You can deduct business expenses to lower your taxable income, right? So this is a sample financial aid from Duke, right? So cost of attendance is $72,710. Family contribution is about 20. Remaining need is about 52,000, right? So 52,000, right? So if this is you, let's say this is your kid, your son or daughter, right? And they calculate that based on your assets and your income, you can contribute 20,000. They will actually pay about 53,000 for you. And I have some real live examples right now. Okay. So this is Lucy, one of our clients, right? One of our firm's clients. So financial back in 2012. So the cost of attendance is 60,300. Okay. Expected family contribution based on their income and assets is 8,350. Okay. So they're eligible for about close to 52,000 in financial aid. Okay, and that's what she got. Okay, this is another sample, right? So the parents' adjusted gross income is 172,000. You can see some of their assets, right? They have 47,000 in their cash and checkings and savings. Market value of the home is 650,000, right? Parents owes, et cetera. So this is a cost of attendance for Cornell. So this is following the first example that I showed you for this child, right? So it's about 57,000 a year for Cornell's back in 2011, 2012. Okay. And a contribution from parents, they calculate based on, all their income and assets is about 39,000. Contribution from the student, right? Student works is about 3,000. So they expect that, okay, this family can contribute about 42,000. So guess what? They got an A. They got about 15,000. Okay. This is another example. This is the first year, right? In UPenn, right? So cost of attendance, 60,000, right? Total aid is 43,000, right? This is the second year, right? Cost is 62, right? Aid plus loan, right? So total aid is 40,000, right? Similar, 64,000. And you can see every year it goes up, right? From 60,000 to 62, this now 60, almost 65, right? And your aid, the aid they got was 45,000, right? Same thing right here, right? Continues to go up. Okay. So what are the excluded assets? Okay. So what this client did, what our company helped them do was we helped them strategize and plan and put a lot of their money in excludable assets, which I'll mention in a bit. Okay. And what these vehicles are. So let's look at Princeton University, right? The following table shows the average grant awarded to students admitted in class of 2020. See, one of the people's misunderstanding is that, oh, I make too much money. I make six figures. I make $250,000. Well, guess what? Even if you look at this, even if you make 200 to 250,000, right? Gross family income, husband and wife. Look at this, 80% qualify for aid, right? So that's not true at all. Even if you have to make more than $28,000 a month for you not to be disqualified. A lot of people don't know that. Okay. And like what the flyer said, there's actually over $2 billion of financial aid last year unclaimed. This is money that parents like yourself could have used, free money for your kids' education, right? But guess what? You don't know about it, right? That's why you're here learning, right? So average grant was about 27,000. Even if you need 200 to 250,000, your child, the average child still got about $28,000. That's about 60% of the tuition, right? So they cover the other 22,000, right? What about 250,000 and above, right? Less qualified, 27%, right? But they still got 20,000, right? For about half, almost close to half of the tuition covered. Princeton, right? So pretty awesome, right? What about University of Pennsylvania? Right, same thing. If you make between 190 to 220, right? The median, which the average is about 30,008. About 84% of the people that applied got it. You see, most people, they don't apply, or they don't know how to properly structure and plan where to put their assets. Maybe they put too much of the assets in all the includable asset classes, which I'll share it with you. Okay. So average financial aid package for incoming freshmen in 2015 was $48,000. Okay. So what's the includable? What's the excludable, right? So includable means that the money that you put in there, it impacts your ability to qualify for more financial aid. That means the more money you have in here, the less financial aid you get. So your checkings, your savings, your CDs, which is what most people put their money, right? Stocks and mutual funds. Some people have that. Trust funds, right? 529, Cloverdale, investment property, resident, your home equity. If you have too much home equity, right, that could count against you, right? What's excludable? Your 401k, your IRA, retirement plans, right? However, right, your retirement is for your retirement. Yes, you can use it for your kids' education without the 59.5 rule, right? That means you can use your 401k IRA for higher education. There's no penalties and taxes. However, if you think about it, if you make $100,000 a year and the college education is, let's say, $30,000 a year, you need to pull out what? About $40,000 a year, right? Because it's pre-tax money from your 401k. And that's going to get added to your taxable income. So now your taxable income is 140. So maybe you raise it to a higher tax bracket. So 401k or IRA is not recommended to use for your kids' education. Yes, you can use it, but it's not for that purpose. It's for your retirement. So if you do use it, you're going to end up getting a huge tax bill, right? And a portion of your retirement is gone, right? So it's not recommended, right? Annuities. Well, annuities are you can't really touch it till you're 59.5 on the gains, right? And so that's not, unless you have kids later down the road when you're 40 or 41, maybe you can use that. But again, it's not the best place to put your money, right? What's another place you can use it? 7702, right? That's using life insurance, right? What kind of life insurance? So we're going to talk about it. Okay. So this is actually on the the FAFSA application, right? Free application for federal student aid. So investments include real estate, do not include the home you live in, right? Trust funds, right? So your home is excluded, but if you have too much home equity, it could count against you, okay? As you saw from the earlier slide. Trust funds, UGMA, we talked about this, UTMA accounts, money market funds, mutual funds, CDs, stocks, stock options, bonds, other securities, installment, land, sale contracts, including mortgages, held commodities, also qualified educational benefits or educational savings, Cloverdale, 529 college plans, refund value of 529 prepaid tuition plans for, right? So pretty much everything besides these three, right? Investments do not include the home you live in, the value of life insurance, the cash value. So there's permanent life insurance that builds up cash value. That does not count, okay? Retirement plans, 401k, pension funds, annuities, non-education IRAs, KIOG plans. Those are, a lot of different types of retirement plans. Yeah, so includable assets, right? Just a review of what we talked about, right? Excludable assets. Okay, so this is an example, right, of using a 7702 Index Universal Life, using a life insurance to save for your kids' education. Why? Because number one, it grows tax-free. It works exactly like a 529 plan in terms of taxes. You're using after-tax dollars to contribute, and it grows tax-free every year. You don't need to pay tax every year. When you take it out, it's tax-free. Okay, it's linked to the index, right? And I'll show you. So this is the historical average performances. Okay, for the index type of product, there's also a variable type, which I got my son because, I want to get better interest rate, right? 7-8% is pretty good, right? But, I looked at the performance and, my son has a lot of time, 18 years, a long time. So I like taking risks, right? But it depends on you, right? For this product, the good part is you don't lose money if the market's bad, but if the market's good, right? It's based on the index. So they'll look at the index, stock market index, like the S&P 500, right? From when your plan started to the following year later, right? If the index did well, let's say 10%, then they'll credit your account with 10%. What if it did bad? What if it went down like first quarter last year? Then you'll get a 0% floor. So you're guaranteed not to lose money. So you have safety and you have the potential to get a good interest if the market does good. And usually subject to a cap on how much you can earn. That's a maximum you can earn, depending on the company. Some companies are up 10, 11, 12, 15%. Okay. Good thing about us, I'm independent, right? So I represent a lot of different companies like Nationwide, Prudential, Pacific Life, a lot of different financial wealth management and insurance companies. Okay. So this is an example. Let's say, right, you're a parent that's 31 and you just had a son or daughter, or you just started, right? Actually, let's say they're 3 years old. Let's say you have a 3-year-old son or daughter and you started putting away money for them, right? You put away about $14,000 a year, right? And some of these you'll see is because there's a maximum amount allowed to put into an insurance policy. Why? Because the money grows tax-free. If there's no restriction on it, then the rich and the wealthy, they'll just dump in all the money they have and have it grow tax-free. That's too good to be true. What's the minimum? What's the maximum? It's based on the age and how much life insurance you have, right? You see this child got a $1 million policy. Right now, for the child to get a $1 million policy, the parents need to have double. Okay, so obviously this is a client that can save a little bit more money, has a little bit higher income. So you see, from the time their kids are ready to go to school, they could pull out about $40,000 a year tax-free income. If you looked at all those slides I showed you earlier, this is probably more than enough to cover, right? Because financial aid will cover a good amount of it, whether maybe a quarter to half of it or maybe more, right? This is another example, right? Again, the interest rate 7 to 8%, right? So common misunderstandings, right? What are the common misunderstandings about this, right? We have high income, we have no hope, right? I cover that, right? You got to make more than $28,000 a month to not qualify. What if you lose your job when you start applying, right? You need tax, estate planning, start a business. You don't have high income. You go, oh, you know what? We don't have enough money. Right? Well, then more the reason why probably you need to plan, right? Because there's no guarantee that you're going to get a good financial aid, or you calculated your expected family contribution online. There's no hope. Well, the calculator on the web is not 100% accurate, right? So we're almost done here. Public schools are cheaper than private schools, right? If you plan well, you may pay the same. This is one of the misunderstanding myths that people have as well. They believe that, you know what, private schools are much more expensive, right, versus public schools, right? Let's say 50,000 versus 25,000. So they go, you know what, because I don't have, all that money, let me send my kids to a public school, a cheap, lesser expensive school. Here's the thing, that doesn't matter. You know why? Because your expected family contribution is the same regardless. So if you go to an $80,000 a year school and financial aid FAFSA calculated based on your assets and your income that you can contribute $30,000 a year, they're going to give you 50. If you go to a school that gives you 30,000, that's 30,000 a year, financial aid calculates that you can afford 30, they're going to give you nothing. You follow me? So as a matter of fact, you actually want your kids to go to a more expensive school because they're going to cover the rest for you. That's how it works. Okay. So as you can see from this example, right? No loan financial aid package, 56,800. The grant they got was 53,500, right? Because the expected family contribution is 10,000. Same thing right here, right? The financial aid package, 20,000, right? Student loan, so expected family contribution, the cost of attendance. So they pay for most of it for you, right? Because your expected family contribution of what you can afford is the same. Okay. So which plan best suits your needs? Right. So there's, like we mentioned, all these UGMA, right? Cloverdale, 529, index universal life or variable universal life, right? So you look at it, right? We'll talk about parental control, right? Only UGMA, you don't have that. Tax deferred growth, UGMA, you don't have that. Tax-free access. The half you see is if they don't use it for their education is not tax-free. IUL life insurance, it's the only one you can use that's tax-free, even if your kids don't go to school, right? So one of the things I tell the parents, if they don't go to school, and they don't get a job or start a business, guess what? That money is yours. You're the owner. You control it. So you don't want to give it to them. You don't need to. It's your money. You can spend it. But let's say they do well in school, or they get a good job or they start a business. They're working hard. They don't need to go to school, right? That at least for me and my Yaru, right? But they can use it for other things like a down payment on a home, a car. Maybe they get married, a wedding, right? All these different things. Okay. Investment flexibility, right? Only 529 plans don't have much flexibility. Family protection, right? Obviously, none of these have, because it's not life insurance, right? Life insurance, not only can you use it for your college, there's also a death benefit paid for your family, right? No penalty for other use, right? UGMA and IUL. No impact of financial aid. Life insurance, as you saw, is one of three that does not have an impact on financial aid, right? So remember, there's an income tax and 10% penalty on earnings of the 529 and education IRA if not used for education purposes. And here's the thing, for life insurance, not everybody qualifies. It depends on their health situation. Proper design is needed by financial professionals, looking at your income, how much you can afford, right? And so take action. The earlier, the better. Save smart, invest wisely, reallocate assets, minimize your expected family contribution. We can show you how. Right. Again, we offer, I'm offering everybody a free 30-minute free consultation. Right. So reallocate assets from includable to excludable. Right. Have a business income. Right. Go from W-2 to 1099. You can write off more of your income. Professionals can help make a difference. Always apply. Right. And finish with this. If you fail to plan, you are planning to fail. Benjamin Franklin said that. Right. So I'm pretty much done here, but I did want to share with you, all of you, this. I know I went about 10, 15 minutes over on time. Appreciate you guys for being patient. So this is another example of, this is actually one of my partners, his sister, his younger sister, right? For obviously I blocked out the personal information, right? This is from 2017 to 2018. The cost of attendance for USC was $72,000. She actually graduated a few years ago, started working. Look at this, gift aid, $52,000. The parents wanted her to get a student loan so she can have some responsibility. So the net cost for the parent was $5,000 a year. $5,000 a year to go to USC, right? Pretty cool, right? Because they planned about all this. Our company helped them with all these planning needs like 14 years ago, right? When this young lady was still very, very, very young, like 4 or 5 years old, right? This is the year after that, right? As you can see, it increased 75,000. How much did they get in aid? 60,000. Okay. Got a 10,000 student loan. So the net cost was even less, 4,000. Right. And so knowing all this, obviously, when, my wife and I, Yaru and I, we had our first son, right? We know about this. So guess what we did? Well, we started a life insurance policy for our son, right? This is his account. Okay. You guys can see this. Okay. So there you go. Vincent Chang, right? That's my son's name, right? We got him a $500,000 policy, right? Because that's the most he could qualify for. My wife has $1 million. I have $1.5 million, but I'll make sure she gets more so that we can put in more, right? Because they're so young, you can't, exactly put in a lot unless you have a big policy, right? So we just started with $300 a month, nothing big, right? But we're planning to put in a lot more, right? Right. And this is an example of my son's plan. So, right. So again, for me, I want to take risk, right? Because I know that you can earn a better interest, right? Obviously, I've been doing this for 13 years. I know what I'm doing, but if you don't like to take too much risk, or, you prefer having safety but also can get a good interest rate, maybe 7-8%, then probably index would be better. But for me, I want to take risks, right? So, 18 years is a long time, right? I know that in the long run, stock market's always going to perform, right? And so give me an example. So 10%, I'm just showing you 10%. I could show lower as well, but a lot of them, the different funds have performed well over 12%. So I'm just showing you at 10%. But let's say I just do 300, right? By the time my son's ready to go to college, we could take out about $28,500 a year. Pretty cool, right? And then let's say, we put in more, right? Let's say we put in 10,000 a year. Right, which, by the end of this year, we're going to do that, right? We're going to dump in the rest of the money. So and it's flexible, right? Like you can do month to month like us, and then do an annual lump sum if you want to. That's what, we plan to do, right? Or you could just, do a one-time, semi-annual, monthly, quarterly. It's really up to you, right? Okay, there we go. So if we put in $10,000 a year, by the time my son's ready to go to school, right, we could take out $113,000 a year. Probably need that much by the time, he goes to college, because, inflation is so much higher, right? You can see it went up by about, 3, 4, 5% every year. Okay. So that's it for me. Again, I appreciate all of your time, right? So any questions you have? Yeah. So Karen, is it for 1 year or the entire education period? What are you referring to? Which plan are you referring to? If you can please clarify that. Okay. Yeah. If anybody have any questions, you feel free to unmute yourself. You can ask, or you can put it on the chat as well. Or like I mentioned, you'll be getting email from me, right? A follow-up email. And if you're interested in a free 30-minute consultation, we can schedule time to do everything over Zoom. Right? Or if you prefer meeting a person, we can do it as well, right? I am vaccinated, right? With just social distance, still wear a mask, okay? So, yeah.
I think Karen's question was asking whether the 30K or 70K, was that a year's tuition when you first started early on? That's when I saw her chat message pop up. Or was that like a 4-year accumulation? Got it.
Yeah, that's per year. Yeah, that's per year. Yeah, 70K. If you look at I think you're talking about USC, right? Columbia, right? Thank you for answering that, whoever that was. Thank you so much. Okay.
You're welcome.
What's your name?
Mia.
Mia. Thank you, Mia. Appreciate it. I actually have a good friend that's her name's Mia too. So, but let me go back to that slide real quick. I think Karen was referring to this. Right. This is per year. Yeah. Per year. We wish it was 4 years, right? Yeah. Yeah, this is per year. By that example I showed you for USC as well, that's per year. Yeah. So if you think about it, $75,000 a year, that's $300,000 in 4 years. The average person doesn't even make $75,000 in a year, right? So, but yeah, like I said, the earlier the start, the better. Mainly it's just get yourself educated, right? Because I feel like a lot of parents do not have this type of education, just like, what my wife does in, helping pediatrics, right? Pediatric physical therapy. A lot of parents do not have this type of education. And she educated me a lot about it, right? And I start, putting in, whatever I can do to help, right? Because I have no experience, but she's the expert, so I listen to her, right? And saying here is that we're the expert, right? Allow us to help you, teach you more so that you could be better equipped, right? Because we all need a plan, right? I know most of you are probably Taiwanese like myself, right? And if you're not, that's okay as well, right? Or other types of Asian, or maybe you're not Asian, right? But one thing I know about, Taiwanese or Asians, right, is that we want to make sure we set a great future for our kids, and not just Taiwanese or Asian, a lot of parents out there, but, specifically, I feel like Asians, right? We definitely want to do that, right? And so that's why all of you, are, learning from my wife, right, on about how, pediatric physical therapy, right? Because you want to educate yourself and get your kids off to a head start, right? Like my son, obviously you guys know, like he's doing things, we have actually a few friends that have kids around the same age, and he's, more further on developed than all of them. Right. And, he's about to stand by himself, and he's only 9 months old. Right. And it's just amazing. Right. And I had no idea a lot of the information until my wife told me. So anyways, but yeah, any other questions anybody have? Okay. Pikas, are there any different considerations 40 plus new parents need to make? What do you mean different considerations? 40 plus, I'm assuming that's your age. Can you please clarify? Okay. Are there any different considerations? No, it doesn't matter about your age, right? It matters about your kids' age, right? Because let's say, for example, if they're 1, then yes, then you have a lot more time. If they're 5, then you have less time. So the more time you have, the better, right? Because the less you need to save, the lesser time you have, well, you still need to save, right? You just need to save more. It's like that example I showed you right here, right? Like this example I showed you, that if you start later, you need to save more to get the same amount, okay? Yeah, either way, it just, requires planning. So hope that answered your question, Cindy. Pika Cindy, cool name. No problem. You're very welcome. Any other questions? Okay, awesome. So, well then, I'm going to, my wife is still showering my son, so I'm gonna let her know real quick. I wanna see if she wanted to say anything. So I will be right back, okay? Give me a minute. Okay, so yeah, she's still showering my Vincent. So, but yeah, that's it for me. Again, you guys will be getting follow-up emails if you guys are interested. You have my contact information, or you can get it from my from Yaru, right? And again, we could do a free 30-minute consultation. Oh, she's coming on now. Okay.
OK。哦，希望大家有学到很多东西。刚刚 miss 掉，因为要准备弄他睡觉。那大家有什么问题吗？应该都问完了吧？
Yeah, there was a few questions and I answered.
Oh, okay, okay. Yeah, he's really good. So if you guys have more questions, just contact him.
Yeah, I'd love to help. Whatever way we can help.
Yeah, yeah. All right.
Appreciate all your time. Thank you again. And we'll hopefully I get to personally meet some of you. And yeah.
Okay.
Okay.
That's all for today.
Right. Have a great night. Bye.
Have a good night.
Thank you, Neil, Yaru.
Okay.
No
bye.
problem. You're very welcome.